Ladies and gentlemen, good day and welcome to the Bata India Q4 and FY2024 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participants' lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. And I've handed the conference over to Mr. Varun Singh from ICICI Securities Limited. Thank you, and over to you, sir.
Yeah, thank you, Neha. On behalf of ICICI, it's our absolute pleasure to host Bata's 4Q earnings conference call. From the management team, we have Mr. Gunjan Shah, MD and CEO, Mr. Anil Somani, Director of Finance and CFO, and Mr. Nitin Bagaria, Company Secretary.
Sorry to interrupt you, sir, but our management line just got disconnected.
Okay.
And just give me a minute, I'll connect the management line.
Yeah, sure.
Please stay connected.
Sure.
Thank you for patiently holding. We have the management back on the call.
Thank you. A warm welcome to all of you. We have Gunjan Shah, India CEO, and we also have Anil Somani, Director of Finance and CFO. We have shared the presentation with the stock exchanges earlier today. We'll be taking you through the same. We'll navigate the slides as well as the page numbers to stay synchronized. On slide number 2, we have the disclaimer. I'm sure you have gone through the same. I'll now request Gunjan to take over and thank you once again for joining.
Okay. Hi, ladies and gentlemen. Good to meet you again after the quarter. Sorry for that disruption. We had to switch because of some kind of a power blip. But I will start off with slide number 4, which is the key drivers that we've been consistently trying to track for and update you on. So some of the key highlights, and I'll touch upon and expand on a few of them in the subsequent slides. The premium segments continue to outgrow. Red Label, Comfort, Power, all have grown significantly ahead of overall growth, despite the overall sluggish conditions that we still see. Floats continues to power at a very high level, and now it's reached almost mid-single digit contribution, almost doubling for the quarter, 16,000 pairs average weekly sales, and obviously the peaks of the season and the monsoon lie ahead of us. Sneaker Studios also helped drive the sneaker growth, reached almost 700 stores now. On retail expansion, we added almost 24 new doors, slightly lower than what we expected. We would want to have a run rate of almost 40 doors every quarter. Hopefully this quarter we'll make up that run rate. That's the run rate we have almost achieved for the last 2-3 quarters. Weighted distribution continues to hold pace. As I had mentioned last time, considering the kind of demand scenario on the mass segment, our focus has been towards extraction from the current set of outlets and distributors, and that's where the focus remains. Renovation facelifts continues at, in fact, preponed, and I think one of the reasons why our franchise openings might have been a little slower. We did almost 70 stores, highest in a quarter, and we hope that gives us basically a significant blip up in terms of same-store growth going forward. On marketing, we continue to invest. Marketing expenses have been higher. I had mentioned that even in the December quarter as well as in the March quarter. We continue to invest behind the brand. We did largest 10x10 campaign, both digital media as well as in our stores, and did have impact on the brand metric. On the digital footprint, the e-commerce business continues on its trajectory, both in terms of driving growth as well as in terms of profitability increase. And all the channels have done exceedingly well, including our own .com channel. And the Omni piece, which is also now spread most probably the widest Omni penetration that we've got, both in terms of points of sale as well as in terms of depth of adoption, I think in the industry is that, and now has expanded to almost 400 franchise stores also getting looped into it. On the supply chain side, we did do basically a significant automation of our second largest warehouse, which is in Mumbai. And we also did a large project in terms of monetization of Faridabad land, which is almost on closure. Stay nimble on costs. We continue to be very hawk's eye on fixed costs largely. We would have loved much higher leverage on basically from a top line perspective, but even then they were under reasonable control and helped us manage our profitability at least. And last but not the least, I have mentioned this, almost an 18-month-long project on ERP has gone live successfully and smoothly on 1st of April. And we are looking forward to obviously benefits accruing from it in terms of speed, agility, as well as accuracy of business enabling decisions on commercial side. Moving further to slide number 6, expanding on a few of these quickly. The COCO, as I mentioned, continues to expand. We added net 3 COCO stores. Obviously, we closed also some unprofitable or non-brand value-adding stores. The larger piece of expansion continues, as you can see in the longer-term trajectory also, is on the franchise side, albeit a little lower than what we would have wanted, and we will want to catch up that run rate this quarter onwards. Obviously, franchise continues to deliver great growth, and we have also on the COCO side significantly made a move. I had mentioned this last quarter on getting the freshness, trendiness, etc. into not only the top 500 stores, but also the bottom 800 stores. And there has been a significant headway that we have managed to achieve across categories. And we plan to beat that up with a piece that I'll talk about a few slides down the line. In terms of portfolio expansion, 3 or 4 large pockets, largely consistent with the direction that I've given earlier also. First Power EBO store has been opened in the north in the quarter that went by. This will be very quickly. In fact, the second one's been opened in April, and we want to quickly ramp that up. On a conservative basis, we look at least 10 stores by December. Hopefully, it'll be even larger. We will follow a cluster strategy, and we will want to saturate / go into depth in north first before we expand further. Similarly, Power Apparel has gained momentum back again after the winter miss that we had. And we are looking forward to not only refurbishing a lot of the learning that we have gained over the last 6 months, but also ensuring that we now start looking at expansion of 200 stores by December. We also did the launch of 9 West. 9 West we had tied up in 2023 with ABG brands on that front. And the soft launch happened in 40 stores in February in the last quarter. We will be now following up in this quarter with a significant launch as well as making sure the full range comes through including the non-footwear, which is expected to be almost half of the entire business. And the marketing campaigns plus the expansion should take us to about 70 stores by December 24. Floats is the other piece. While we've seen great response, we have invested in a lot of technology, a lot of new styles, a lot of forward-looking investments in terms of molds, etc. that we have put in. We keep getting great response on this. The speed at which it is putting out of the store is very encouraging. We have now gone to double-digit doors in terms of pop-up stores. We hope to continue that momentum even more aggressively on floats, even outside the Bata stores. And we should be looking at ambitiously a first EBO on floats by quarter 3 of this year. On the e-commerce side, I think, as I mentioned, robust growth that we managed to see almost across channels on a reasonably large base that we anyways had last year in this quarter, and backed by volume growth and Bata.com also doing well. We did have a record number of Omni business that we did from our stores. So almost 1 million pairs actually is a great landmark for FY24 that we crossed to just Omni. There were multiple campaigns, a refresh of the entire Bata.com site that we did and relaunched it. And I'll invite many of you all to also visit it. It's a great site to go through. On the distribution business side, while the business is still muted, it has been a drag on the overall growth rates even for this quarter. We have seen some signs of mass market showing some resuscitation, but still early days. For the quarter, it's been a drag. We continue, obviously, the work in terms of key retail outlets and making sure that we are also pushing towards extraction from these outlets. We did launch the entire and expand on the entire EVA range, which has been, I think, a growth category for almost 18 months, something that we should have caught on much earlier. But anyways, for the last 6 months, we have now launched it. It's now very quickly ramped up into the 5th largest category for the distribution business. And I think, as I mentioned, even in floats, at the price point that this range sells in distribution business, it is not under floats. It will have a significant blip up in the next couple of quarters because of the seasonality. As I mentioned, we continue to invest behind the brand. Multiple campaigns that we ran, and with slide number 11, Bata 10 on 10 was the centerpiece of the entire thing, bringing about style and comfort both together in terms of casual as well as occasion. It's consistent with the Every Walker Ramp Walk campaign that we ran the previous quarter, and backed by obviously digital campaigns in various ways. We also obviously launched 9 West, as I mentioned. A large piece of the marketing piece on 9 West, etc., will happen this quarter. And this was reinforced with making sure that some of these communication/stories are brought alive in the stores in terms of brand stories for significant new collections/technology that we're introducing, as well as kids engagement areas, using technology like digital screens, etc., and most of the renovated stores. On slide number 12, some key accolades across technology, green practices, sustainable practices, marketing campaigns, as well as in terms of diversity. And that endeavor obviously continues. With that, moving to slide number 14, which is the financial section. This finally resulted in, I think, lower than expected in my mind, growth rates at about 2.4%, though better than what we have seen for the last 2-3 quarters. We would hope that this trajectory improves even further going forward. Despite that, in slide number 15, as you can see, I had mentioned that in the last quarter also, our investments behind IT and marketing, some of the initiatives I've talked about, ERP has gone live. They continue apace and hopefully set us up for as the demand cycle improves and cycles back. But these will help us basically improve our efficacy as well as efficiency in terms of operations. The last chart on margins, gross margin was protected reasonably well, I would say, during this quarter, despite the tough trading conditions, and that resulted in leverage into EBITDA. However, overall leverage, we still would have desired more from a fixed cost perspective, etc., and we will look forward to top line driving us, and that's going to be a focus going forward also. That brings me to the end of the presentation. Thank you for listening in, and we can have the questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Girish Pai from Nirmal Bang Equities. Please go ahead.
Yeah, thanks for the opportunity. Gunjan, in your TV interview in the morning, you talked about a demand pickup in March. And is that demand pickup sustaining into April and May?
Yeah, so I can't give you forward-looking forecast, Girish, and obviously very soon we'll come back to you for the next quarter. But the piece is that, yes, we did see an improvement during the quarter from a Jan, which was actually much worse, but to a March, which was a little better. But still not giving us complete clarity in terms of how the underlying conditions have changed. As I mentioned, there are some signs and pockets that we see, but is it lifting the entire boat? We'll have to see how it comes over a longish period of time. So that will limit the comment of mine right now.
My second question is on the channel mix and channel growth in FY24, now that the full year is done. Which have been the channels which have been driving growth for you in FY24, and which have been the drags? And I would want specifically comments on the Coco channel. How has the growth been there?
Okay. Yeah. Right. So broadly, the growth engines that have delivered in terms of growth would be the ones that is franchise, I would say e-commerce, and hush puppies from a channel mix perspective, right? The ones that are playing at the lower end of the price point, the biggest drag. So Coco would have been just about at par for the overall. It is the distribution business and the lower end price point related business that has been the drag on the growth.
Okay. My last question is with regard to the variability in gross margins across quarters. What is driving this variability? And the 60% gross margin, is that sustainable going into the future?
It's actually, I would say, a reasonably predictable seasonality. Obviously, there are some variables that do come into, get accentuated depending on, one is the circumstances of the business, as well as, more importantly, festivals moving from one quarter to another. But broadly, there are two large things that create a mix change. One is EOSS, which comes into basically, let's say, the June quarter as well as the December quarter. The second one that there is basically a certain mix of a certain kind of a business. So let's say if, the sneakers goes up, that goes with slightly higher margins from a Coco perspective. But you will also have times wherein the school business goes up, and that time the margins do come down. But they do follow a reasonably predictable pattern if you look at it over longish periods of time, and that should not deviate much. The only large deviation that we can possibly have is festival season moving from one quarter to another. Yeah.
Sorry, if I can squeeze in one last question. The channel mix in terms of revenue, if you can give that for FY24?
Yeah, so Coco would be about 70%. You will have distribution business in the mid-teens, e-commerce in double digits, low double digits, and you will have franchise in the higher single digits.
Thank you.
Thank you.
Thank you, Ganesh.
The next question is from the line of Vidisha Sheth from Ambit Capital. Please go ahead.
Hi. Thank you for the opportunity. My first question was on the product mix. What is the mix of discounted or full price sales within the revenue? And also, you've been taking a lot of initiatives on improving the frequency of new launches and even on overall better inventory management. So as a result, to what extent can this benefit in terms of increasing the full price sales?
Yeah, yes. So there are slightly different objectives, Vidisha, for this question. So the newness is towards driving freshness. People want to see range and fashion in the store, and consumers come to us at a frequency of about 3 to 5 months, right, on an average. And therefore, they would like to see new styles and new varieties, and wherever applicable, new technologies, etc., coming through. And that's what this concerted drive was. I think over the last 2 years, we would have made significant improvement on it. The initiative that we have been driving for the last 2 quarters, and which is what I tried to give some snapshot in my presentation, was to make sure that it percolates across the entire network. And earlier, a lot of that used to be concentrated in the top 500 stores. We wanted to make sure even the bottom 800 also get equally impacted. And that's where basically the minimum threshold that I had set, which was at least 20% by store, by category, should be desirably fresh for the season. The second piece that you mentioned was that how does that help in terms of, so that's the prime driver. Does that help full price sales? For sure, it does. But a large part of this newness does not necessarily drive volumes. The volumes are driven by the ones that the consumers are repeatedly consuming. And some of it is bestsellers and news. So bestsellers and news, which are carryovers from previous season that have done well, will be large contributors to volumes. Therefore, the sales mix comes from those. The last piece on markdown of the portfolio in the range of ballpark, as I said, it varies. In the previous question I answered, it varies by quarter, but in the ballpark of about mid-teens would be the portfolio range that goes under markdown on an average.
That was helpful. And on the second question was on the apparel bit. Any incremental update on the apparel portfolio in terms of the response and how are you trying to get incremental SSG from the same? Basically, just trying to understand what is your right to win in this segment and how is the same communicated to the consumer?
Yeah. So we've got a going-in hypothesis, which is what I shared a couple of quarters back when we had launched it, which was the going-in hypothesis being basically getting in almost the best kind of technology with obviously the right kind of design as well as comfort, fit, etc. Right, at a certain value proposition that we wanted to, where we felt that the consumers did give us in the consumer dipstick response on it. The piece, however, that we, and some of it was the going-in hypothesis, there is a lot of learnings that we have come. One clear case, I mean, there are, maybe a half a dozen more, but one clear case that came was that as soon as we hit October, we were not ready for the winter wear. I mean, it's in retrospectively sounds so obvious, but it is something that we were not ready for. And obviously we'll make sure we are ready this time around. But the piece was that there are similar learnings on some other pieces. There's obviously enhancement of our understanding of that piece and therefore technology and proposition that we want to give to consumers. It is, I would say the last quarter was the best that we have seen till now in terms of apparel contribution in the stores that we have launched. It is still below the threshold that will allow me to expand, but the trajectory gives me confidence, as I mentioned. Therefore, in H2, we want to double the number of store network as we hit the threshold.
Got it. That is helpful. And just lastly, on the ad spend for the full year, if you could share that number.
It's been in the guideline of about 260 basis points. Last quarter, actually 250 basis points. Last 2 quarters would be higher than that. And that's something that we have been trying to do to try and navigate some of the sluggishness that we see from a consumer sentiment point of view.
And the 2H run rate is something that you would look to continue even in FY2023-24?
Sorry, Vidish.
Can you just repeat that question?
Yeah, sure. So, and the 2H run rate, which was relatively elevated, you'd expect would you continue that run rate in fiscal 25 as well?
Investment in marketing.
In terms of investments on ad spend.
But it's not 2x. I don't know where you got the...
No, in 2H. I meant the second half.
The second quarter run rate. Yeah.
Yes.
Broadly ballpark, yes, we will run with that run rate. In fact, we might want to invest a little more, but we will also nimbly play with the overall conditions that we see.
Thank you. That's all from my side.
Longer term glide path, we would like to take it to about 3%.
Understood. Thank you.
Thank you, Vidisha.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Aniket Sakhare from Meta Capital Advisors LLP. Please go ahead.
Hello, and thank you for the opportunity. So, as we see, sneakers have become social currency of self-expression, a symbol of street culture. So, sir,
sorry, Aniket is not clear. A little louder, please.
So, hello. Thank you for your opportunity. So, as we see, sneakers are become quite trendy right now. So, sir, going ahead, how we look at the trends in the sneakers and for the industry as well as for our store purpose?
Yeah. No, so actually, sneakers, as I mentioned earlier, is actually, 2-3 segments per se, right? One is obviously performance. The second is lifestyle. There is also casual, which falls under the sneaker segment. And our sneaker studios has been an endeavor of bringing it all together. So hitherto, it used to lie within various parts of the store. And a part of all this renovation that we do is bringing it all together. I think if you're looking at basically in terms of what is it that we are wanting to invest within this, I think the easiest wins that we have seen over the last about 12-18 months since we have put a largest push towards the has been in the casual and lifestyle. Performance is what we are pushing forward. Power performance last quarter shows that there is signs of it. It is coming from a distinct USP that you deliver to consumers and therefore build your credentials overall from the sneaker perspective. And the EBO will also add to it. Our EBO ASP of Power is almost 1.5x of the ASP that we have in our stores. So it just showcases that once you're able to display the full range, but it's a journey by itself, right? I mean, developing the kind of performance sports credentials and therefore the tech behind it, while we are leveraging our global parentage as well as the R&D that's going behind it, but that's the space that we want to really tackle well through the EBO route.
So, sir, I'm referring to our slide number 4 of our PPT. So, as you mentioned, we have implemented sneaker studios in 698 additional stores, right? So, in terms of number, you can specify that how it is going to supplement our revenues.
Yeah, that's what I mentioned, that these are sneaker studios, which are basically a panel within the Bata stores. And that is what we want to make sure that we bring across the entire proposition of sneakers to our consumers and register on them. And that's given us great response. The fastest response has been basically in the lifestyle and casual. So it's not additional stores if that's what you're looking for. It is basically sneaker studios, which are panels within the Bata stores.
Yeah. And last question from my side. So as we see, our sales have been quite reduced from the last quarter comparison. But, sir, if we see, our COGS has increased, specifically the raw material. So is it due to price hiking raw material?
You're talking sequentially?
Yeah.
So the
COGS has gone up.
The gross margin piece, the question is relating to the COGS piece, right?
COGS. Yeah.
Yeah. So typically the COGS we have improved our gross margin, which is the impact of both majorly coming from mix, and COGS per se has no major change. So you need to take into account the COGS plus the change in inventory. Obviously, it would not vary significantly.
Okay. Thank you for the opportunity.
Thank you.
Thank you.
Our next question is from the line of Lakshmi Narayanan from Tunga Investments. Please go ahead.
Thank you. Couple of questions, sir. First is, as an organization, when you actually draw your business plan or strategic plan over the next 3 years or 5 years, how do you build in your growth expectation? And what is it based on? Like, how do you do it top down and bottoms up?
So it's a very broad question, gentlemen, but broadly the piece is being made from, it starts from first principles, which is economic growth. How do we see within that the consumption piece? Then it moves into the industry, and therefore what is our ambition juxtaposed against these inputs at a top-down level. Then obviously it comes down bottoms up in terms of, brands, what is our ambition on various brands, the categories within that, and lastly the channels. So in a very simple form, this is what it will be, but then it will have manifestations in terms of org structure, supply chain capabilities, technology, etc.
So in general, if you look at it, if you just look at next 5 years, what kind of industry growth you actually expect? And when you say that you have performed well, do you have a benchmark saying that, look, we have performed more than some kind of an industry average? So how do you calibrate yourself and say that, look, we have done well or we have not done well, we should do well?
Yeah. So our endeavor is to make sure that we are edging ahead of the industry growth. The industry growth estimates based on various inputs that we get. But I mean, nominally speaking, it should be GDP growth plus the inflation, minimal. And that works out to almost low double digits in that lines.
Got it. And the second question is that if I just look at your presentation, it would have been good to have some breakup in terms of your regional sales mix or your price points mix, or in terms of leisure, casual, formal, or men, women, children, or something like that. Is it that by design you don't want to share it, or is it that you think you can actually share it?
No, it's a combination of both. It's also a question of how much we want to load information together. I try and keep it to the highlights, but more than happy to entertain any queries wherever we can offline.
Because the context is that as I walk into a Bata showroom, I find a lot of brands, right? So, but as an organization, and it depends on whether I walk into Bangalore or Chitradurga or Chennai or Tuticorin, it differs. So, as an organization, what are the brands you want to push? What is the mid segment growth? What is the is formal growing faster, or is premium growing faster? It's something which I can get into a lot of details, but if you can just help me understand what is the men, women, children mix, for example, that could be insightful.
Yeah. No, so what might help, I will answer that. But in case there is a query that you've got which is a little more detailed or offline, you can please send that across and we'll try and address it. Basically, our contribution of men is in the range of about 40 to 45%. Our ladies mix is about 30%. Children's is in low double digit, and non-footwear is in high single digits. Lakshmi Narayan, is that you? Okay.
Yes, sir. Yes.
But yeah, you can please reach out as I mentioned in case there is some more details.
And if you actually look at as an organization, premium, what is your cut? Like, how do you say that this is premium and this is, is there a rupee at an MRP you decided, and if so, what is that cut and how much? What is the revenue contribution ballpark?
Yeah, the premium mix, I have given commentary, Lakshmi, but however, since you have asked it, greater than 2,000, which is 2x of our ASP, is what we consider as premium. Obviously, Hush Puppies, let's say, runs at almost 4,000. But overall, as a basket, that continues to grow faster. The one that is the lower end, which is, let's say, less than 1,000, less than 500, which is less than now about 10% of our turnover. Now, that's basically the one that's been tracking, as I mentioned in my commentary at the start.
Got it. And last, in terms of your inventory.
Sorry to interrupt you, sir. I request you to come back for a follow-up question.
Thank you.
Thank you. Our next question is from the line of Jasmine Surana from VT Capital. Please go ahead.
Hi, sir. Congratulations on the numbers. Most of my questions have been answered, but I wanted your take on how you are looking at demand and sales on a year-to-year basis, say in the months of April and May.
Yeah. So as I mentioned earlier, Jasmine, I will refrain from giving a forward-looking forecast, but we are optimistic in the medium term, and we are hoping that some of this demand cycle, some signs that we have seen in the previous quarter, sustain and consolidate, but we need to see it over a longest period of time.
Sure, sir. I just have one more question on the other expenses. I wanted to understand what has been the difference QOQ from quarter 3 and quarter 4, why there has been a sudden hike in the expenses last quarter, and what is the sustainable number that would be fair?
Okay. Prima facie, Jasmine, and if possible, we can share details offline. But our 3 large elements, 2 of them I've talked about. In fact, all 3 I commented, but 2 of them I put up, which is marketing, IT. That's a large expense that we have incurred. Not only this quarter, but the last quarter, but for the full year, it's been a large investment, and we have charged off the entire ERP expense during this financial year. The other piece is obviously marketing investments continue to grow ahead of turnover. The last piece that is there, that has been somewhat a function of BIS in some form, has been basically freight cost element, and some I think we can do more efficiently, but it's between these 3.
All right. Thank you so much. I'll take the rest of them offline.
Thank you.
Thank you, Jasmine.
The next question is from the line of Anurag Lodha from Axis Capital. Please go ahead.
Yeah, thank you for the opportunity. So you indicated that
the demand trends have been improving from Jan to March, right? So I just wanted to understand, like, how are you looking at demand shaping up for FY25, and what are the key levers of growth that you foresee?
Yeah, it will stay consistent to what I have mentioned in my presentation. We will want to make sure that, some of these focused portfolio additions, portfolio brands, casualization and sneakerization definitely, red label-led fashion, as well as comfort-led comfort is basically the focus brands that will drive us. As I mentioned earlier, while it has been overall a tough trading conditions, even for the quarter that went by, we did see some shift in it between Jan to March. We will have to wait and watch and see how this consolidates over a longish period of time. Our endeavor in the medium term is, as I indicated to some other participant, was that we want to get to a consistent double-digit revenue growth.
It seems like our current participants got disconnected. We'll move over to our next participants. So our next question is from the line of Vikas Jain from Equirius Capital. Please go ahead.
Hi, Vikas. Thank you, sir. Thank you, sir, so much for the opportunity. So first question is with respect to this BIS implementation. So in the 4Q, was there any impact because of this BIS changes in our either sales or in terms of positioning? Anything that you want to speak about?
No, as I mentioned, even in the previous quarter, we were ready for even the 1st Jan implementation, which was the earlier date of the quality control orders under BIS. And while the date has been revised by the government to 1st August, and therefore our readiness remains, we obviously did prepone some imports, etc. And since the leeway has been given, we have very small quantities. But we don't anticipate any disruption from our operations perspective. In fact, the supply chain has been extremely agile. One of the first, in fact, actually the first factory to get the BIS license was our Bata factory way back, almost 8 months back. And therefore, since then, obviously, the entire manufacturing network has got BIS certified as applicable.
Got it. The second question is with respect to the ERP implementation. So you mentioned that ERP has been running from 1st of April. Now it's almost like 2 months that the ERP is fully active. So any comments you want to make there as to like how, was there any probably, if at all, is there any disruption that was there, or how has been the integration across all the stages? Any comments there?
So why don't I ask Anil Somani, who's been leading it from a finance IT perspective, to respond to it?
So the overall, the ERP implementation has gone well. All integrations are working fine. We are obviously in a stabilization phase. So once we do that, there would start our journey of, leveraging the data analytics piece and all. So it's going as per the plan, and we are happy with the progress.
And your last question that I understood, Vikas, was that has there been any kind of a material business disruption, etc.? In fact, kudos to the team. There has been zero disruption on that front.
Great, sir. Great to hear that. So, in last question, if you could answer, could you share the contribution from the premium brand, that is a Floats or Hush Puppies and Power for the full year? What was the the scale that it achieved, all these brands?
They will cumulatively account for almost something like 40% of our turnover.
Got it, sir. Got it, sir. Thank you so much, sir. I'll get back to the question.
Thank you. The next question is from the line of Varun Gajaria from Boring AMC. Please go ahead.
Hi, sir, and thank you for the thank you for the opportunity. Am I audible?
Yes.
Okay. So just wanted to understand. So from adding around 150 stores a year, what is the plan as to like the mode in which these stores will be open? So will we be using more of the franchisee model, or will it be more of COCO?
No, so I have mentioned this. As you can see, even now from a trend, while there was a period post-COVID where for almost about 12 to 18 months we were still weeding out a lot more stores than we were adding from a COCO front. But that, I think, largely the exercise is done. Obviously, there's a continuous process of weeding out non-profitable or non-value-adding stores to the brand. But we are adding net cocoa stores that will continue. However, from an aggregate perspective, I think that's the other question that you're indicating towards. We will have predominant franchise store additions, which is in the ratio of 80-20. Does that answer your question?
Hello, Mr. Varun.
I think we lost it.
Hello, Mr. Varun. Further questions from the line of participants. We'll move to the next participant. The next question is from the line of Priyank Chera from Valum Capital. Please go ahead.
Yeah, hi, sir. Hi. So what are the strategic interventions required in the distribution channel? And despite getting at 39% of the freshness, have we lost any market share in that channel? And what has been the real problem in that channel for us to grow?
Yeah. By the way, the freshness that I talked about was largely from a retail perspective, cocoa as well as franchise, including hush puppies. But the other question that you mentioned, which was in terms of the distribution channel, see, there are areas that we can do better. I think the biggest one that was there was basically that about 2 years back, towards the fag end of 21 and obviously a large part of 22, there was significant inflation. And most of the industry, as well as ourselves, we had to move up prices. And at that price point, which is a mass segment, which is an MRP, which is below 700, consumers are extremely sensitive to it. And that did create its own, struggle from a consumption point of view from the consumers. We have refrained from price increases now for the almost 5 quarters or a little more, maybe 6 quarters now. So middle of let's say second half of 22-23, and that hopefully should at some point in time get absorbed by the consumers and move forward. Independent of that, which is more a consumption and a pricing environment and an inflation adjustment scenario that I've talked about, there are a couple of things that we are pushing forward. One is basically making sure that we latch on to a few categories that we feel that either are the horses that are running much faster than otherwise. The second one is ensuring that we are able to extract some of the distribution expansion that we have done over the last 3 years. So as you can see, our weighted distribution, which is making sure the quality of distributors and the size of distributors that we are engaging with has significantly gone up. The number of outlets have gone up. Now we are at almost something like 30,000 MBOs. Now the focus is towards ensuring that we've got depth and penetration both at the distributor and outlet level, backed by obviously making sure the right kind of categories play that we make. One of the examples that I gave you was the EVA category, which has shown good signs, but there is a long way to go in terms of making an impact in that category, where I think we were delayed by about almost 12 to 18 months.
Right. And what has been the like-to-like growth in your retail cocoa channel, ex of franchise, of course? What has been the like-to-like growth for the full year in cocoa channel, and doesn't seem to be, at least the revenue growth seems to be again very muted in this channel too. So if you can highlight, like you highlighted for distribution channel, what are the strategic interventions required to get the growth pedal back in the cocoa channel also? Yeah.
No, thanks for that. We don't share the like-for-like growth, but however, obviously the overall growths have been muted. The piece that we are working on is on 3 angles. One is, as I said, this entire piece of making sure that we are able to get more trendiness going. Clubbed with that, we want to also do some kind of rationalization of complexity in store in terms of number of lines. And H2 will see almost a 20% reduction in terms of number of lines that we want to bring. So one is bring in newness in terms of portfolio, make sure it's penetrated well across the network, and simultaneously reduce the complexity. The second biggest piece is driving footfalls, and therefore making sure that, for example, right now in this quarter, we are running a never before industry first promo in terms of try and fly, and running obviously thematic campaigns, highlighting some of our stories and USP. The last piece was something that while we have inched forward, I think last quarter we finally hit what I wanted, and which is making sure that the store manpower variable pay for performance hits the benchmark that in my mind was about 30%, and that's hit there. And that has shown basically encouraging signs on conversion as well as NPS of consumers from store.
Sorry, I couldn't get the rationalization of the lines, which you said will be done in H2. You mean that you would cut down few brands, or within the brands you have more SKUs which you will have to cut down to get the correct mix?
I mean, at a first principle level, it is basically trying to bring in that every product of mine, does it have a reason for existence or a proposition to the consumer? Right. Now, that's the idealistic level that I want to get to. Now, effectively, if I've got a sneaker and a sneaker and a sneaker, does it have a color proposition? Does it have a style proposition? Does it have a technology proposition? Does it have a price point proposition? Now, it has to tick mark on either one of these, right, to make sure that it's got a reason for existence. And outcome of that exercise is basically making sure that we are able to, therefore, remove redundancies, which are maybe, not necessarily offering differential propositions for itself to exist in a store.
But sorry to harp again on this line. We have been working on the product effectiveness within the store for now quite some time. So why would we again rationalize it? And I think rationalization is something which keeps happening every year, every quarter, every day. So is there a very significant rationalization that we should think ahead?
Which is what I'm talking about, that we want to, so you're right, it's an ongoing process. The question that we want to basically make sure that we are solving for, as I said, is to make sure that we are looking at first principles all over again. And that is coming out with an impact that is going to be differential to what we anyways do on an ongoing basis, season on season. So you will have end of season sale, you will liquidate a set of stuff that doesn't work, you will bring in a lot of new stuff to bring in new trends, etc. Right, and that's what you mean by basically something that happens on an ongoing basis and does happen. The piece that I'm talking about is differential, which is to make sure that you look at zero-based. Is there a proposition that we would like to look at, the line from existence perspective, and simultaneously, as I said earlier in my call, which is making sure that the newness is percolated across categories and across stores. In addition to this, there will be a relook at a few brands, whether they make sense for a certain cluster of stores, whether up the pop strata or down the pop strata.
Perfect. Just a last question from my side. If we can share brand level performance for the full year, the key marquee brands like Bata, Hush Puppy, Power or North Star, and as well as if we can share the contribution from the school shoes for the full year would be great.
So school shoes contribution is about mid-single digits. The brands, I will not be able to share immediately all the numbers on it, but as I mentioned earlier, the premium brands that I have talked about, Hush Puppies, Power, North Star, Comfort, etc., they contribute to about 40% of our turnover.
Sorry, I was asking for the full year performance. If we can, on a qualitative basis.
Okay, so let me come back to you offline on that.
Yeah, Priya.
Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, we'll take this as the last question, and I've handed the conference over to the management for closing comments.
Thank you everyone for joining. Looking forward to interact again. Thanks a lot.
Thank you. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.